Why is Argentina facing a crisis? What factors have contributed to its economic turmoil? Is high inflation a significant issue plaguing the Argentine economy? How has overspending exacerbated the country's financial woes? Stay tuned, as we delve deeper into Argentina's economic challenges and explore potential solutions in this video. High debt servicing costs. As debt accumulates, servicing the interest payments and principal becomes increasingly burdensome. High debt servicing costs constrain government finances, leading to budget deficits and the need for further borrowing to meet debt obligations. Currency depreciation. Argentina's borrowing often occurred in foreign currencies, exposing the country to exchange rate risk. Currency depreciation can increase the cost of servicing foreign debt, as the amount of domestic currency needed to repay debt denominated in foreign currency rises. Credibility issues. Persistent debt crises can erode investor confidence in Argentina's ability to manage its finances effectively. This loss of credibility can lead to higher borrowing costs, making it more challenging for Argentina to refinance its debt and exacerbating its debt burden. Default and bankruptcy. In some cases, Argentina has defaulted on its debt obligations, either by missing payments or restructuring its debt. Default can lead to a loss of access to international capital markets, further isolating the country and exacerbating its financial difficulties. Overall, while borrowing can provide temporary relief for fiscal pressures, unsustainable levels of debt, coupled with economic vulnerabilities, can ultimately lead to bankruptcy or severe financial crises, as seen in Argentina's case. Addressing underlying structural issues, promoting fiscal discipline, and implementing sound economic policies are essential for avoiding such outcomes in the future. Trade controls and excessive money printing can exacerbate economic challenges in Argentina in several ways. Distorted market signals. Trade controls, such as tariffs, quotas, and export restrictions, distort market signals and hinder efficient resource allocation. These controls can lead to inefficiencies, reduce competitiveness, and limit growth opportunities for domestic industries. Reduced foreign investment. Trade controls can deter foreign investment by creating uncertainty and limiting market access for international businesses. This reduction in foreign investment can hinder economic development and limit the inflow of capital needed to support growth and innovation. Inflationary pressure. Excessive money printing to finance government spending or to support unsustainable economic policies can fuel inflationary pressures. When the supply of money outpaces the growth of goods and services in the economy, prices rise, eroding purchasing power and reducing standards of living for ordinary citizens. Currency depreciation. Inflationary pressures resulting from excessive money printing can lead to currency depreciation. A depreciating currency makes imports more expensive, contributing to inflation and reducing the purchasing power of consumers. It can also increase the cost of servicing foreign debt denominated in foreign currencies. Capital flight. Trade controls and inflationary pressures can contribute to capital flight, as investors seek to preserve their wealth by moving assets out of the country. Capital flight reduces investment within the country, slows economic growth, and exacerbates external imbalances. Overall, trade controls and excessive money printing can create a vicious cycle of economic instability, leading to reduced competitiveness, inflation, currency depreciation, and capital flight. Addressing these issues requires implementing sound economic policies that promote market efficiency, fiscal discipline, and sustainable growth. Argentina has sought various solutions to address its financial challenges and avoid bankruptcy. Some of the measures and strategies pursued include debt restructuring. Argentina has engaged in negotiations with its creditors to restructure its debt obligations, aiming to reduce the overall debt burden, extend maturities, and lower interest rates. Debt restructuring agreements allow the country to manage its debt more sustainably and improve its fiscal position. Fiscal reforms. Implementing fiscal reforms to reduce budget deficits and improve government finances is crucial for long-term economic stability. This may involve measures such as cutting government spending, increasing tax revenues through tax reforms, and improving budget transparency and accountability. Monetary policy. Adopting prudent monetary policies to control inflation and stabilize the currency is essential. This may include tightening monetary policy to curb inflationary pressures, maintaining exchange rate stability, and restoring confidence in the domestic currency. Structural reforms. Implementing structural reforms to improve the efficiency and competitiveness of the economy can help stimulate growth and attract investment. This may involve reforms in areas such as labor markets, regulation, trade, and investment climate to promote productivity and innovation. Strengthening institutions. Strengthening governance institutions, including the central bank, regulatory agencies, and judiciary, is crucial for restoring confidence in the economy and ensuring effective policy implementation. Building institutional capacity and improving governance can help enhance transparency, accountability, and the rule of law.